Hey traders, in today's video, we're going to talk about why past performance does matter. Hey guys, Candlesticks here. Welcome back to another Trading Edge video, the weekend edition, the YouTube weekend edition. If you guys are brand new, thank you as always for joining me. I'm a Forex trader. I'm a trading coach. I'm one of the co-founders of Tier1Trading.com. And the Trading Edge is a bi-weekly video that myself and my trading partner, Jason Greystone, produce for our members on the Tier 1 platform. And what I try to do each and every weekend when I get the time is share with you a little of that video here on YouTube. So I try to pick out what I think is either the best opportunity or the most educational opportunity and share it with you guys. In today's video, we're going to take a look at the euro dollar. We're going to talk about a trend continuation opportunity. We're also going to talk about why past performance does make a difference in your trading and why trading is really all about a game of probabilities. But before we get into today's video, do me a favor, hit that like button, share this on social media, and make sure you subscribe if you are new. Make sure you hit that little bell as well. That way you're notified each and every time I produce a video. Also, I'm sorry to inform you, but the videos from our Trading Edge workshop have been removed as promised. We said we'd only keep them up till August. We kept them up a few days after that and then removed them. But if you're looking for some more free education, make sure you head over to our website, www.tier1trading.com. We have 2 free webinars that you can watch, the Ascension webinar and the Trade to Measure workshop. So although you can't get the Trading Edge anymore, the workshop, you still have access to 2 webinars and workshops completely free. So check it out, and I hope you guys enjoy today's video. We're going to get started this week. Move my mic over a little bit. We're going to get started this week on the euro dollar. And the euro dollar is a continuation off of, if you guys remember, one of the main pairs on my radar for last week. Now, going back to last August, right? Not this past August, but August 2018, right? We've been speaking about the same numbers, right? 113s, 110s, 108s, 113s, 110s, 108s. That higher time for prediction still holds true after over a year. Nothing technically has changed. So I still think the euro could go lower. And what we saw last week, if you guys remember, we identified the violation of a previous level of structure. I'm always a little slow here on TradingView since it's not my main platform, but we identified the violation of a previous level of structure, that lower low, lower close. That allowed us to make the prediction that price is likely to continue lower. And one of the ways of getting involved in that was waiting for a pullback trade. Now, what we identified was, or what we predicted was, if price was going to pull back, where was it going to pull back to? And we did a few things, right? First of all, we had our previous level of structure right here. Give me a second to sneeze. There we go, much better. One, not only do we have our previous level of structure support, which we would now look to act as resistance. And again, come on, TradingView, always bad. There we go. But we had a few other factors as well. Earlier in the week, we took our Fibonacci's. We did it from this swing high to this swing low, kind of our bigger move. We saw a zone between a 382 and a 50% right here. We even took a smaller Fibonacci retracement as well from our most recent impulse leg, swing high to swing low. And we saw the combination of a 50% and a 618. Now again, 50% is not technically a Fibonacci number, but it is a halfway point. It's a psychological number, and that's why we pay attention to it. So we had a few things lining up. We had previous level of structure. We had Fibonacci confluence. So for you CTS traders, start adding up your score. And when we went down to the lower time frame, the 240, what we were looking for is we were looking for 2 things. We were looking for price to really come and reverse somewhere in this level for 2 reasons. One, this was kind of the last settling point before a big bullish breakout. For you guys that are familiar with supply and demand, you know these type of candlestick formations are going to be important. And then 2, as we came back down into this level, we kind of wrote out a pretty nice story, right? Not only did price come down and reverse at this level, hard to see here, but as price returned to this level of support, we actually saw a rejection up here before breaking through. So this level did hold a little bit of power before trying to push back up. However, as the buyers pushed back up, you can see that, well, they didn't really get too far as we immediately saw selling pressure. And part of making predictions in the market is just, paying attention to past performance. I don't get it as much because I think we're dealing with a much more educated group of traders, obviously on the platform, but also on YouTube. But every once in a while, you get the trader that comes out and he says, well, there's no point at looking at historical data. There's no point at looking at what the market does in the past because it doesn't tell us what the market's going to do in the future. And the answer to that is yes, right? There's no way we can predict the future. Trust me. If I were able to predict the future, I would never lose a trade again. I would bet everything I have on every single trade because I would know the answer. So duh, right? Obviously. But what the past does is it gives us clues. It shows us tendencies. And when we have clues, when we have tendencies, we can make better predictions, right? It's, same thing. Think about it like this, right? Every time you go in your car, for you guys that don't have push button starts, every time you go in your car, I guess push button start or no push button start, and you push the start button, right? Or you put the key in, you twist it. What do you expect to happen? Well, you expect for the engine to come on, right? The car to come on, right? Why do you expect that to happen? Well, because that's what it's done in the past. Now, does it always happen? For you guys that are maybe driving, older cars, sometimes you, right, has trouble starting up. Doesn't turn over, engine doesn't start, right? So there's no saying for sure that when you push that button or when you turn that key, the car is going to start, but you're able to make a pretty confident prediction that it will because it did it in the past. Now, obviously, making predictions in the markets aren't that, aren't that efficient. I mean, you would think 99 out of, 999 out of 1,000 times you turn that car key, it's going to work. In the markets, the odds are a lot lower. But the same principles apply, right? We look at what the market has done in the past. It gives us clues, right? So then we can make predictions on if this happens at this level, then we can make this prediction. And then what we do is we make that prediction. We're predictive in our analysis. We're reactive in our execution, meaning that we wait for the prediction and then we wait for price to kind of, what's the word I'm looking for? Price to kind of not complement that prediction, but I don't know, there should be a big fancy word I use, but give us signs that that prediction is more likely to happen than not. And then we put a trade on in the way that we predict price to go. And obviously we manage our risk. And when you do all those things together, you have a pretty solid trading plan. Not only are you putting yourself in a position where the market is more likely to do what you expect it to do versus not, but you're managing your risk. So when the market does follow through, you win more. When it doesn't, you lose less. And that's just called playing the probabilities. So paying attention to this level where we saw the sellers reject price before, this was a level that we had on our radar to watch for rejection in the future. Now, I did get involved in this trade on Friday. We had a lower low, lower close after this move. This was a news-related move as well. But there is an opportunity to get involved in a short as well. But before we get into that, a few more things that we have just to kind of follow up on some of the conversations we've been having in the live room. Tier 1 members, if you get a chance, go back to check the live room recording archives either Tuesday or Wednesday. We did a great session, I think it was Tuesday, on the RSI and different ways to use it. We talked a little bit about the RSI swap, which is when you see the price action go directly from this oversold condition to this overbought condition. I love that in trend continuation opportunities. We also talked a little bit about hidden diversions. So price action putting in lower highs here on your price chart, right? However, on your RSI, we're getting higher highs. That's another good sign for trend continuation. So you can see for you guys that are new, this may be a little bit too much for you, but understand the principles that we're taking all of these clues, we're putting them together, and that's how we're making a prediction. But for you guys that were interested in the RSI, you may want to reach out to our trader Latch. You see him on the chat all the time. You see him on social media all the time. I forwarded him a book recommendation called RSI, The Complete Guide by John Hayden, which is a really advanced way of looking at the RSI. I don't recommend it to newer traders at all because it's very confusing. I think it's going to just like give you paralysis analysis. But for the more experienced traders, for someone that uses the RSI and wants to really dig into the different ways of using it instead of just looking for overbought and oversold, it's a great read. He's currently going through it right now. So if you want to get on the chat and discuss it with him, or even on social media and discuss it with him, I think it would be a benefit. But we have all these things lining up. What I would wait for is this. I'm getting back to the actual trade. If we go down to the hourly, wait for a violation of these lows, right? I'm going to delete my chart real quick. Wait to see if price action can take out these lows. If we can take out these lows, right, that's going to give you another reason to get involved, whether it's in a bear breakout, whether you're looking for a breakout and a pullback, and then an extension. But that's a secondary reason to get involved. And we have plenty of room to the downside here with euro dollar. Again, either coming to our previous level of structure down here at about 109.50s, or of course extending a little bit further to 108.50s, 108 even, where we see our previous structure looking left on the daily. So euro dollar is one that we watched all week. Last week I did take a loss on a cipher there, but did get into the trend continuation trade that I wanted to get involved in last week, and hopefully we'll see this week follow through. Of course, remember Thursday we do have some ECB news coming out, so make sure you do your research on that, especially if you're someone that's looking to either avoid this or use it as a potential home run trade. All right, next we're going to go to dollar Canada. All right, hope you guys enjoyed that. Before you leave, again, remember, hit that like button, subscribe if you are new, share this. And if you have a question or a comment about anything that we discussed here, make sure you leave it in the comment section below. Many of the comments that I read here on YouTube end up turning into podcast episodes from my Trading Coach podcast. So I do go through each and every one. And if you have a question, it will be addressed either through the podcast or I'll go and respond to you below. All right, hope you guys have a great weekend. Football Sunday starting for the first time, so I'm excited. And until next time, plan your trade, trade your plan. Take care.